Hi, this is Marie from Legacy Publishing. In today's video, we are going to explore global investing. Chuck, can you tell us about the investing opportunities available in international markets?
Marie, many international stock markets currently offer better investment returns than the U.S. stock market. Many foreign economies, such as China and Brazil, are growing at a much faster rate than the U.S. economy, and as a result, foreign corporate profits are also growing at a much faster rate. The infrastructure build-out in developing countries is leading to strong demand for energy, basic materials, bank financing, and wireless communications, resulting in healthy corporate profits and price gains for many foreign stocks. The Chinese stimulus package has been very effective in expanding the Chinese economy.
Chuck, how can our viewers participate in the investment opportunities available in foreign markets?
Marie, U.S. investors can purchase American depository receipts for international companies like China Mobile or Petrobras, the Brazilian energy company. American depository receipts trade on U.S. exchanges. Another way to invest in fast-growing international companies is to purchase the Emerging Markets ETF, which we can see from the top 10 holdings has a heavy weighting in emerging economies such as China and Brazil. Historically, the Emerging Markets ETF has outperformed the S&P 500 index by a wide margin. During the 2003 to 2007 bull market, the Emerging Markets ETF had a 417% return versus a 96% return for the S&P 500 index. And since the March 2009 bottom, the Emerging Markets ETF has increased in price 101% versus a 58% increase for the S&P 500 index. Now, during the 2003 to 2007 bull market, my trend following system indicated a bullish trend in the Emerging Markets ETF, and I purchased call options on the ETF. Here's an example of an Emerging Markets ETF call option purchase I made. My brokerage account profit loss report shows a $23,500 profit, which resulted in a 130% return over the 6-week period that I held the call option. Now, this price graph compares the price action of the Emerging Market ETF to the S&P 500 index, which is indicated by the red line, over the 6-week holding period for my option trade. This is a good example of how global markets can outperform U.S. markets.
Chuck, can you show us an example of a recent emerging market ETF trade?
Marie, last month I purchased the Double Performance Emerging Market ETF, symbol EET, and sold a monthly call option. The Emerging Market ETF is still in a price uptrend, so at option expiration in 2 days, I will roll over the October options into November options. Options lose time value very quickly during the month prior to expiration, so selling monthly options against the Emerging Market ETF allows me to take full advantage of the time decay characteristics of options. My brokerage confirmation shows that last month I purchased the Double Emerging Market ETF, symbol EET, at $77.48 and sold the October 78 calls at 4.04 points. This created a buy-right trade that can profit if the price of the Emerging Market ETF increases, remains flat, or even decreases slightly. This buy-right analysis shows that the profit potential on this trade is $456 per contract, which results in a 6.2% return at option expiration if the emerging market ETF closes at or above the 78 strike price. Now, the overall goal of this strategy is to sell monthly call options against the emerging market ETF to generate monthly income. The analysis also shows that selling a monthly call option with a similar premium has the potential to generate approximately a 98% annualized return, assuming the emerging market ETF closes at or above the strike price of the short call at monthly option expiration.
Chuck, how do you determine which months to use the monthly buy right strategy?
Marie, the monthly buy right strategy can profit if the price of the emerging market ETF increases, remains flat, or even decreases slightly. But I still like to trade the monthly buy right strategy only if the emerging market ETF is in a price uptrend to give me an extra safety cushion. I use the crossover of the 50-day exponential moving average with the 100-day exponential moving average to determine price trend. When the 50-day EMA is above the 100-day EMA, a price uptrend exists. I also like to use the on-balance volume indicator to determine if an ETF's price uptrend can be sustained. An upsloping OBV line indicates that the volume flow is heavier on up days and lighter on down days, indicating that the price uptrend is likely to be sustained. Here is the daily price chart for the emerging market ETF. Note that the 50-day EMA, which is the blue line, is above the 100-day EMA red line, indicating the ETF is in a price uptrend. And the on-balance volume line at the bottom of the chart is trending up, indicating the volume flow is heavier on up days and lighter on down days, confirming the price uptrend. So to summarize, global markets can offer great profit opportunities, and the monthly buy right strategy is a low-risk way to capitalize on these opportunities. The strategy does not require a large price movement in the underlying ETF to be profitable, providing an excellent risk-adjusted return. The sale of the call option provides downside protection if the underlying ETF declines in price, and the strategy incurs less risk than owning the ETF.
Well, Chuck, I hope our viewers were able to gain some insights into the profit opportunities available with global investing. I want to thank everyone for viewing, and I am looking forward to our next presentation.